Hi there, my name is Marie Stein from VAT Exchange, and I'd like to welcome you to this, the first in our VAT blogs, which I'll be doing every couple of weeks, just coming online to have a rant about something VAT related. It might be some obscure piece of legislation or some new rules or some HMRC guidance. But today, because this is the first of our blogs, I wanted to explain a really important VAT principle that can have a direct effect on your bottom line as a business. And it's to do with when you can claim VAT on your costs. Now, if you're a VAT registered business, you have to submit VAT returns to HMRC, usually every 3 months, sometimes on a monthly basis. But on every return, you include two amounts of VAT. One is the VAT on your sales or outputs, which we call output tax. And the other figure is the VAT on your purchases and expenses. Those are called inputs, so the VAT is called input tax. Now, usually the output tax is higher than the input tax, so you pay the difference to HMRC, and that's how the arrangements work. However, that's only part of the picture, because not every business can claim back the VAT on their costs, and I'll explain why. Now, one of the main principles in VAT is that there are two different classes of supply. The first is taxable and the second is exempt. Now, the taxable supplies come in three rates. The default rate is the 20%, which you pay on pretty well everything. Then there's a 5% reduced rate, which is charged on things like, we've got domestic fuel and power and certain residential and conversion services. And then finally, of course, we've got the zero rate, which you're probably all familiar with, on things like children's clothing and food and drink, new houses. There's a whole range of things that are covered by the zero rate. In those situations, those supplies are all taxable, including the ones at the zero rate. That is a rate of tax, and that means you can claim your input tax under the normal rules. However, the other class of supplies is called exempt, and this includes things like residential rent, insurance, banking, certain charitable income, private health services, private education. And if your income's exempt, that means that you can't claim VAT on your costs. So you don't charge any VAT on your sales income, but you can't claim any VAT back either, unless in very certain limited circumstances the amount of VAT falls within certain de minimis limits, which I won't talk about today, but I'll put a link down to the HMRC guidance about the subject at the bottom of the page. But one of the main problems about all of this is that people often confuse the terms zero rated and exempt, simply because you don't charge VAT in either case. But you have to remember that the zero rate is a rate of tax, like the 20% rate and like the 5% rate, and that means you can claim VAT on your related costs. If your income is exempt, you can't normally claim the VAT on your costs, so that VAT becomes an additional cost to your business. So that's why this principle is very, very important, and in particular, this distinction between the zero rate and the exempt rate and the exempt supplies, the exempt class of supplies for VAT purposes. Because if you get it wrong, you will be miscalculating the actual cost of your cost for your businesses, which affects your business, it affects your bottom line, and it could mean in the longer term you end up with an unexpected and very unwanted bill from HMRC because you claim too much VAT back. So remember this principle, remember the distinction between taxable and exempt supplies, and particularly remember the distinction between zero rated and exempt supplies, and the fact that the zero rate is a rate of tax, but the exempt is not. I hope that covers everything. That's all for today. I'll be coming back in a couple of weeks' time talking about something else. Bye bye for now.